These are all the journal entries we recorded in the prior video. If you haven't watched that video, go back and watch it. It's called Analyze Transactions and Record Journal Entries, so I won't take the time to discuss them here. This is a listing of all the general ledger accounts that will be affected by the journal entries on this prior page. As you'll notice, all the opening balances are zero because it's a brand new company. Now, if this company were already in business for a month or so, you'd see opening balances. So make sure whenever you start posting that you have the prior balances. In this case, they're zero because it's a new company, but that will not normally be the case. What we're going to do now is post every single journal entry from the general journal. I've created a T account for every single account in the ledger because this is how it's often taught in accounting courses, and I'm simply going to post these debits and credits into their respective accounts. We had more cash, debit, we have more equipment, debit, and we have more capital stock, credit. As you can see, as I post the information to the respective ledger accounts, I put in the posting reference. We have more building, $200,000 debit, less cash because we paid it out, $40,000 credit, and $160,000 more on the note payable. So in other words, we bought this building by paying cash and taking out a loan. We prepaid our insurance, debit $12,000, more prepaid insurance, and less cash. We now have more inventory, debit $7,000, and we haven't paid for it yet, so it's a credit to accounts payable $7,000. Accounts receivable is debited to show we have more receivable. Sales revenue credited to show we earned more revenue. Cost of goods sold is debited to show we have a larger expense, and we have less inventory, so that is shown as a credit. Commission expense. We have more commission expense, debit, and more payable because we haven't paid it yet, credit. Accounts payable, debited $4,000 and credit cash $4,000. That means we paid off the account payable using up our cash. Here we were receiving cash, debit. Why? Because one of our customers paid off the account receivable they owed us, credit to accounts receivable. Here we're debiting investments $5,000 to show we have more, and we're crediting cash to show that we used cash to buy the investment, credit $5,000. Now we're receiving $200 cash, debit, and we're crediting dividend income to show we earned it. We then paid out a dividend to our shareholders. Our dividends increased $100, that's a debit, which will wind up decreasing our retained earnings. Our cash decreased because we paid it out. That will be a credit to cash. Utilities expense increased $500, debit, and utilities payable increased $500, credit.